Welcome to Dorsey and Whitney's webinar on doing deals in the dental space, preparing your DSO for the next strategic transaction. I'd like to introduce Troy Keller, a partner in Dorsey's M&A group. Troy, take it away.
Thanks, Sean. Thanks, everyone, for participating today. Yes, we realize it's a long title, but it's descriptive. We didn't want to mislead anyone. So if this is what you were looking for, you're in the right place. Actually, let me give a sense before I introduce the panel here. Let me give you a sense for what we'll be talking about today. While our presentation is directed at for DSOs, we're taking kind of a big tent approach. So we'll have a trends discussion and talk about deal making in the sector. So whether you're an investor in the space or a DSO, or even just a dentist that's looking to maybe build a DSO or partner with other dentists, this is probably going to be relevant for you. I also need to go over some housekeeping. So the materials will be available for download from the login, and then also emailed to the participants from our events at Dorsey email. If you have questions during the presentation, type them into the chat feature, and we'll do our best to answer them. And I think we will. We've got an hour, and we'll try to be judicious in some of the things we talk about, so that time-wise, that we'll have some time for questions. If we don't get to it, though, we'll come back to you separately with an email or phone call or whatever. And then finally, after the program today, you'll get a survey along with the materials, and we'd appreciate any of the feedback if you don't mind. Okay, so our guest so Jamie and I are here at Dorsey, and Bob is our special guest. We're excited to have him on. Bob Winder from Logan Growth Advisors, and we know Bob well. He's a great source of knowledge, has a great network in the industry. He is, like I said, president and founder of Logan Growth Advisors, which is an M&A, mergers and acquisitions advisory firm that specializes in healthcare. He is a professor at Brigham Young University, Utah State University, where he teaches private equity and mergers and acquisitions. Prior to being at Logan, Bob worked as a private equity investor and then raised his own fund and purchased a group of dental practices, which he ran and later sold. So he's got great operational and kind of financial investment experience. He also mentions, he also says in his bio, he's a novice rancher. And Bob, I'm really tempted to ask you how many head of cattle you have, but I grew up in Idaho, so I know that that's like equivalent to asking you what's in your bank account, so I won't. But how's it going? How's the ranching going?
Out of my window, I can see a bunch of cows. Not many of them are mine, mostly my neighbors, but we're learning. We're learning fast and have a lot more to learn, that's for sure.
Awesome. Okay, and then Jamie, a partner of mine here at Dorsey and Whitney, and she is in our nationally recognized healthcare practice. And she has significant regulatory and deal-making experience, whereas I, while the dental space is definitely a focus of mine, while I might be doing a dental deal one day and a fintech deal the next, Jamie is laser focused on the healthcare industry. So we're lucky to have her expertise with us. She represents health systems, physician groups, other providers and payers in M&A, joint ventures, and strategic partnerships. She advises clients on a breadth of regulatory issues, including state and federal licensing requirements, corporate practice of medicine, Stark Law, state and federal anti-kickback statutes, and HIPAA. She also has significant pro bono activities. She's co-chair of the Minneapolis Women Attorneys Rescue Group and advocates for reproductive rights. And she's just a star, and we're really glad that she's on. Okay, we are going to do one more kind of get to know you with our panel. So Jamie, and maybe this is kind of answered by what I just read, but how did you, why are you in the dental and healthcare space? I'll ask both of you that question. Let's start with Jamie. How did you end up here?
Yeah, that's a good question. Hi, Troy. Thanks for having me. So I started my career doing dental deals actually on the strategic side as a junior health M&A associate. they can go pretty quick, right? So I got a ton of experience on the acquisition side, understanding both the regulatory and also the corporate side of things. So it's been a part of my practice ever since I was a junior associate, and I've worked both on the strategic side and the M&A, on the private equity side. Mostly on the buy side. I've done a little bit of sell side work too.
Oh, fantastic. So you grew up as a lawyer in the space. Wonderful. Good.
Exactly. Yeah, not as a toddler. I was not doing M&A as a toddler, but as a junior associate. Yep, that was kind of my first preview.
Okay, Bob.
So coming out of the last recession, the Great Recession, I worked in private equity, and at the time there's a flight to quality. We want to invest in recession-resistant assets. So healthcare has a big target for us. And back then, dental was really becoming in vogue on Wall Street. Just a lot of good tailwinds, largely fragmented, a lot of consolidation beginning to happen. Even though the DSO model had been going on for years and years, or even decades before that, I feel like around that time, it really became very popular and started to roll up a lot faster. And so I was involved in a lot of dental transactions and just was really interested in the space, saw a lot of upsides, saw a lot of synergies, a lot of ways to win. And so from there, as you mentioned in my bio, I raised some capital and went and bought a group of dental practices myself with a friendly dentist, which I'm sure Jamie will go over in a minute what that means. And it turned out was not nearly as fun or exciting or as easy as my spreadsheet predicted. It was very difficult, but I learned a lot, in that time running a group of dental practices. Ended up selling those to a bigger DSO. And from there, having experience on the buy side, the operation side, then, the only other side to play was the sell side. And I had lots of business owners, dentists, founders reach out to me, talking about private equity or strategic partnerships. And so started this boutique, M&A shop that's focused on healthcare and a lot of dental. So yeah, I've been at it for about 10 or so years, seen a lot of change, and it's been a good ride.
Fantastic. Well, thanks both. We're so glad to have you on. Okay, we're going to jump in. And first, we thought it would be useful. Like I said, we're not going to go over. I mean, we could be here for 2 days talking about all the different aspects of doing transactions. We're going to try to hit on some themes, some trends, some things that are very current event type stuff. So in that mode, though, we're gonna pause for a second and talk about a few some terms that are oftentimes used in the space, especially on the investment side, and that'll be helpful, I think, both for people who maybe are new to this, but also for those who aren't, but I just want to hear how people think about some of these common terms. Things evolve over time. So first, we're going to focus on these first two. Well, actually, let's start with the DSO, MSO, dental service organization. Jamie, do you want to describe what we mean by that term when we refer to that?
Yeah, sure. So DSO, dental services organization, MSO, management services organization. I think everybody on this webinar probably has some familiarity with those terms. That is the entity through which the investment occurs. That's the entity that manages and controls all the non-clinical aspects of the company, and that's how Bob puts his cash in, gets his cash out. That's the typically it's an LLC, I think, and it's the organization that either dentists themselves can invest in, but also non-professionals can also invest in this entity.
And you mentioned the clinical versus non-clinical. Do you want to cover those terms while we're on as well? I remember the first time I heard that, I said, what are we talking about here?
Yeah, it's kind of funny. I had a call last night with a corporate partner of ours, Troy, who had the same question. He doesn't have a ton of experience in our world, even though he's like a super sophisticated deal lawyer. He's like, can you tell me the difference? Yes, I can. So in our world, clinical operations or clinical assets are those assets that need to be controlled by a licensed professional. We like to, for tax purposes, and you can call me later to talk about structure, but for tax purposes, we like to have clinical operations, clinical assets be as small as possible. So those, if we're going as narrow as possible, are payer agreements, they are medical records, and they are any licenses or accreditations that the organization has. Everything else is non-clinical. That would be the tables and the chairs and the things that you need to run a dental office. We would capture those. Those would those would be in assets of the MSO and sit in that non-professional entity. Is that good enough, Troy?
that is really great, and I think that is fantastic. I know maybe just one more thing, and I know it comes off oftentimes. Who can be employed by which, or who needs to be employed by which?
Yeah, that's a good question. It depends on the state, Troy. I think, for example, in Utah, you guys over there don't have the corporate practice of dentistry, so I think the MSO in your state can employ dentists. Here in Minnesota, dentists need to be employed by the professional association or professional organization that's owned by a dentist. Every state has a very complex web of called corporate practice of medicine or corporate practice of dentistry that affects who can employ, also who can own, and sometimes where those assets need to sit in which entity. So it can get really boring really fast. Yeah. Yep.
Great. Let's move to the financial side. Bob, everyone loves to talk about EBITDA, particularly in this industry. And I think everyone has their own view on exactly what it means in the dental space. Do you want to, throw your hat in the ring on that?
Yeah, absolutely. I love this topic. EBITDA, earnings before interest, taxes, depreciation, amortization. It's a proxy for cash flow. It's not a great proxy. Obviously, there's some things that are left out, but this is what the investment community has decided on as the benchmark for valuation. So practice level versus corporate or DSO level EBITDA are very different. And people talk about them differently when they ask, what's your EBITDA? Yeah, is it practice level, is it corporate level, or DSO level? Practice level literally means the EBITDA that's generated from the four walls, the actual practices, without the overhead from the corporate infrastructure. And depending on your DSO, you may not have a lot of corporate infrastructure, or a lot of that infrastructure is already baked in at the practice level. And so your practice level may look really close to what your corporate or your DSO level EBITDA is. Or perhaps you have another entity and you have business services and the expenses of those that are running through this other entity, and then layering on that expense as a management service or a support service for the practices. And therefore you would have a difference between the four wall or practice level EBITDA and the DSO level EBITDA. From a valuation standpoint, if this is considered a platform, you have multiple practices, this is a true DSO, 99% of the time, you're going to be valued based on the actual DSO level EBITDA. Depending on who you're working with, potentially if you're negotiating with a larger DSO, there can be some add backs based on potential synergies, because some of those services will be redundant, what they will already provide. But generally, the corporate or the bottom line DSO level EBITDA will be what you use. Now, if you're a smaller group or just a handful of practices, you may not really have a DSO infrastructure or a lot of DSO expense, and so practice level EBITDA is appropriate for valuation at that point.
I've seen sometimes that the official EBITDA can look very different from one practice to the next, just because the dentist, who might also in most cases be the owner or the largest owner in a small DSO, has a larger salary or takes home more compensation in one than the other. Is that something that gets kind of normalized across? Do you tend to see that, or do you have to prepare yourself and as a dentist to take less just to show more EBITDA? I don't know. Yeah,
the EBITDA, fortunately or unfortunately, is not a generally accepted accounting principle. So which means there's a lot of subjectivity to its calculation, and everyone seems to have their own perspective of what should be included in EBITDA or their version of the calculation. Unfortunately, it's not always the same, and so that a lot of the negotiation and argument and analysis is based on determining a really good defensible EBITDA. And so, as you mentioned, one potential add back is an owner's salary or potential deduct. A lot of times owners don't take a salary, and so their EBITDA on their raw financial statements looks fantastic. Looks like a 40% EBITDA margin or 35% EBITDA margin. Well, the first question we ask is, how much is the owner how much owner salary is actually flowing through the P&L, the income statement. And if it's 0 or a very low number, then we have to normalize that or spread it across multiple locations, as you alluded to, Troy. So there's a lot of those adjustments and add backs and one-time events that we calculate that we incorporate in our EBITDA calculation. So definitely something not to be taken lightly. Use a professional, help you calculate an aggressive but still very defensible EBITDA, because it is very subjective.
Yeah, numbers don't lie, but they can be, isn't the truth in the eye of the beholder. So there you go. Okay, the next one, Bob, why don't you actually cover the next next 4 bullet points, the strategic versus financial. And Jamie, feel free to jump in any of these, but in the cost and strategic synergies, a few more kind of financial terms that are pretty relevant for the sector.
Sure. So strategic investor, financial investor, or strategic versus financial. This, from a private equity perspective, defines who is bidding to win the deal. So who's a buyer? So a strategic generally refers to another company. So in the DSO space, if you're a group of dental practices and another DSO, a larger dental service organization or group of practices approaches you, that's considered a strategic, versus if a financial investor that doesn't have an underlying company that does similar services, if a financial investor approaches you, then that's a financial buyer. So a strategic versus financial can have very different deal terms and can have very different operations post-close, but they still run we run a very similar process. The valuation that they do is very similar with some nuanced differences. So if you hear me say strategic, in this context, I really just mean a larger DSO.
Perfect.
And the synergies, sure. So DSOs, so if you are a smaller group of practices or DSO, you get approached by a larger DSO, a strategic. Part of the reason they're interested in you is for synergies. So, are there cost redundancies that they can take out to improve EBITDA? Did they have a better fee schedule that they've negotiated with payers? That would be more on the revenue side. Did they have better supply contracts or lab contracts or agreements? They can reduce the cost structure. They have some type of streamlined operations or internal call center or support centers that they can take personnel out of the practice and therefore reduce costs that way. So their cost synergies are real, and that's definitely a driver for consolidation. But the bigger driver of consolidation that we see is more on the strategic side, the strategic synergies, and mostly that's due to multiple arbitrage. So that's my favorite term ever. So multiple arbitrage. Hopefully everyone remembers that and uses it sometime this weekend in your casual conversation with your friends. That's usually that I tell my students that, all right, I'm going to teach you multiple arbitrage, and then I want you to go use this in casual conversation and then report back, write me a quick essay on what it was. So multiple arbitrage. Multiple is evaluation methodology. So the multiple of EBITDA is typically how private companies are valued, specifically in dental. That's how most of these are valued, unless it's a one practice that's being sold as a percentage of collections. But for the most part, a multiple of EBITDA is how valuation occurs in this market today. And so arbitrage effectively means taking an asset that has a specific intrinsic value and then selling it in a different market and therefore getting a different price for that. And that's an arbitrage event. There's no intrinsic value increase. You're just selling it. You're just taking that asset and selling it in a different market to have an increase in the value. So how does that apply here in dental? Well, these larger DSOs, platform DSOs, the strategics, they may be trading at an EBITDA multiple 10, 12, 14, 15 times. Well, they can go out and they can purchase or partner with smaller dental groups or even individual practices for a mid-single digit multiple, 5, 6, 7 times. And immediately that same EBITDA that they acquired for, call it 5 times, now that it's applied to or partnered with that larger corporation, that same EBITDA that was bought for 5 times is now worth 15 times. So they immediately get that arbitrage. So that's what we see driving a lot of this consolidation. It's kind of the financial engineering multiple arbitrage, where these bigger groups are buying the smaller ones for a lower multiple and then and then benefiting from that arbitrage event.
And that's where a DSO at any stage, or even especially particularly small one, can benefit from advice, from financial advice, like from someone like you, right, Bob? I mean, because you can kind of help them see, well, you know, you are providing more benefit than you realize, and maybe you help them get the best EBITDA that possible, even though, you know, a strict, like you said, kind of a strict intrinsic cash whatever valuation might not otherwise give them that.
Understanding their playbook, really why a buyer is interested in you as a smaller DSO or group of practices, and kind of how they perceive you, the value that they will attribute to you, gives you just a lot more leverage. Understanding how they see you, understands what levers you can pull, and how you can extract as much value out of that transaction and out of the partnership as possible, while still being a good partner should you choose to engage in that partnership. So yeah, absolutely. Understanding how this all works will benefit you tremendously as a seller.
Thank you. Jamie, do you want to talk about the affiliate, or I think we've used the term friendly doctor as well, and how that, what we tend to mean by that in this space?
Yeah, so in this space, the friendly doctor or the affiliate doctor is usually the sole owner of the professional entity, and that's the entity that holds the clinical operations or the clinical assets. It needs to be somebody that's friendly to the organization, because that dentist will be signing on behalf of the practice. They're not going to be making any non-clinical decisions unless you allow them to in the DSO, but they should be willing to participate and be an active member of the team. Sometimes as a backup plan, we have clients put 2 dentists in place. So just in case one, they're not sure how one is going to fare out, they have a backup. But this person typically is somebody who's internal within the organization. It also could be the practice that is being acquired or selling, that dentist can step into the role of the owner of the professional organization.
And this is probably not maybe it's not unique in the medical, in the healthcare space, but in the kind of the corporate structuring universe, this is a very unique scenario where you have someone who has separate ownership of the clinical side and is not really owned by the practice. Do you see, I know we're just talking definitions, but I think now's a good time. Do you see problems coming out of this arrangement?
So this is a workaround around the corporate practice of dentistry, corporate practice of medicine, where corporations are not allowed to control the clinical decision-making of professionals, right? That's the general landscape. I have seen, preparing for this, every once in a while, there are actions by insurance companies that claim your corporate structure is inadequate, and therefore we do not owe you. The claims that you submitted were improper because you are improperly owned. Those have merit, and those can result in some losses for a practice. Generally speaking, I don't see an issue. Most states have not had to have successful challenges to take down this model. California is probably the closest, like we would all expect. So we pay attention to, I think there was a bill introduced in California that would challenge this corporate practice of medicine, friendly physician, friendly dentist model. It didn't pass, but it is on the radar of the California regulators. So one thing that we keep in mind in my practice, since this is so state specific, obviously you can form an entity and then foreign qualify in states if that's allowed. You want to pick a state that has historical leniency to this model, because you don't want to form in the Californias or the New Yorks and have that be your main entity, and then have the house of cards fall down when that state determines that this model is no longer allowed under applicable regulation. So it's one of those things, and I will, one practice pointer, Troy, if I could just say here, it is so much more helpful when the lawyers involved understand this. this model. It is complicated, but it's not that complicated for a health attorney. So you will save so much money if you hire an attorney who is familiar with the family physician model, and you don't have to have calls after calls after calls explaining why this friendly physician needs to sign over beneficial ownership to the DSO. Just it's an efficiency practice point.
Yeah, I know what you're talking about. I've certainly been there where counsel, can be excellent attorneys, but with the first time they do a deal in this space, this concept in particular is very challenging to get educated on. Yeah, that's great. Okay, and so since I wanted to have an even number of terms here, and I threw in this last one, goblin mode, which really doesn't have any relevance to the dental industry, but I'm going to provide a little bit right here. It is the Oxford English Dictionary word of the year for 2022, which says a little bit about the times that we're in, kind of coming out of COVID. You reflected, I guess, I'm just parroting what I read on the internet, but it's it's reflecting kind of an impetus in people these days to push back on norms and just kind of go crazy with whatever they're doing, and binge watch TV for as long as you need to, and that's great, to each his own. It did make me think that for deal making, one of the best pieces of advice I got as a young lawyer was that that great expression, pigs get fat and hogs get slaughtered, and meaning when you're doing deals in the DSO space in particular, you can be doing a lot of deals pretty rapidly. I think that speed is important, and it's very important, frankly, but don't go too fast. And we'll talk about some of the things that can get you into trouble. Okay.
I was on the edge of my seat, waiting in anticipation for how you're going to define that in this context. So thanks, Troy. That was great.
Well, and it was a new to me, but I saw it come across. And OED is a highly credible institution, so we had to give it some space. Okay, so this is every DSO discussion has the obligatory DSO structuring slide, and so this is our version of it. DSOs are very legal entity intensive because of different states, different rules, especially the more practices a DSO picks up, they can end up with a lot of legal entities. So you will in fact never see, well, I don't know, never say never, but very rarely see a DSO that is this simplified. But we wanted to just provide a couple of provide this structure so you can see some of the components. Jamie, do you want to point out here? I think some pieces of this maybe are relevant to the discussion we just had on the friendly dentist.
Yeah, absolutely. So here, obviously, in the left-hand corner, you have the friendly doctor PC. That, if we had another box above that, would be the dentist owner. The dentist owner would sit above that and own 100% of the shares of the friendly doctor PC entity. The dotted line is likely a management services agreement, and that's the agreement through which the funds are stripped out, or I should not say that. I should say through which the management services organization is furnishing all non-clinical admin services or back office services for the friendly doctor PC, and in exchange receiving a management fee. That management fee is something that changes depending on what state you're practicing in. Some states allow a percentage of revenue fee. Some states do not allow percentage of revenue if the management company is doing active marketing services. So that's another piece from a regulatory perspective. Troy, I promised you that we were not going to go into like drafting MSAs, but that's one piece that a regulatory attorney will be involved in, kind of thinking about what state requirements are in place there. And I think, and the JV, you could have the friendly doctor also sit in a like cloud bucket too, or they can be elsewhere, right? But it's critical that that friendly doctor is sitting above the friendly PC as 100% legal owner.
Thank you. That's perfect. Bob, any thoughts you have on this, maybe particularly on the JV component there?
Yeah, I'm glad you included the JV component. It's often not shown, but it's definitely part of this new era of DSOs. A lot of DSOs are trying to recruit and retain the best talent, and some of the younger docs that have multiple practices that are really eager and hungry, they've come up with solutions to have a joint venture. And so in this case, as this shows, you can still partner with the DSO and still retain a pretty heavy percentage of ownership at this JV level. And so that's what this on the far right is showing, is this JV partnership. It's not with every DSO, but some DSOs are incorporating this joint venture concept, so the dentist can continue to own a percentage of equity at the sub DSO or joint venture practice level, and then even have some ownership at the main DSO or corporate level. And so in this case, they can continue to often get distributions on their percentage of ownership at the sub DSO or joint venture. And sometimes certain DSOs even let them, upon a transaction to the next private equity group, they can trade up some of their ownership at the JV to the DSO and get a bigger multiple. And so there's a lot of different things that are happening with this joint venture model, and it's becoming really, really popular in a lot of different flavors. And I'd love to go into a lot more detail if there's more questions on that, or if we have time, but I know, that's kind of a rabbit hole, but certainly a big part of a trend today.
Well, maybe just one more piece to it, or one more question there. Then why? It sounds like they can get, in some cases, almost a best of both worlds. The dentist participates down here, but can trade up, as you say. Why? What is in it for the dentist partnering down here? Like, what is the trade-off generally in the absence of that kind of best of both worlds?
Yeah, so there's been, and I'll go into the evolution of the DSO a little bit. So initially, decades ago, the DSO was really just, hey, let's, or even, specifically when I was in private equity, it was, there's one or two dentist owners, the rest of the dentists are associates. And that's very clean cap table, very easy to trade from one private equity to the next, and really benefiting from the baby boomer wave of, doctors looking to retire soon and looking at partnering with the DSO as a way to kind of ease into retirement, help with transition, alleviate administrative burden, et cetera. And that was a great solution for a lot of years, and it continues to be a great solution for a lot of dentists that are looking, to just be an associate, not deal with the administrative burden. That's kind of the narrative that we've heard is driving a lot of this consolidation. But lately, there's a lot of dentists that don't really fit that mold, and they're more interested in the upside. So along comes DSO 2.0, which is similar to the MB2s of the world. They come and they say, hey, how about we buy out a portion of your equity, call it 70%, but 30%, how about you reinvest that with us, and then we can all win together. We're all equity partners. We're in this together. And those models were typically investing that 30% up at the DSO level. So you wouldn't get distributions, but you would be part of the main DSO, kind of where the private equity money is, and you could benefit just like the private equity investors. And
so cash now versus cash later trade-off, I suppose.
Exactly, that trade-off. So we see a lot of this model growing and proliferating, and there's a lot of benefits to that model. And then this third model, the DSO 3.0, what I call it, which is even more aggressive in some ways, is this JV partnership where DSOs are looking for these small groups that have a lot of growth and upside, and younger docs, more risk tolerant, want to continue to grow, run their own show, and almost treating them like a regional sub DSO. Like, hey, you're my Florida DSO, you're my South Carolina DSO. You guys grow, you can continue to own 40% of your sub DSO, your joint venture, and continue to get distributions on that EBITDA, et cetera. But you're still partnered with a bigger group, and so you can benefit from a lot of the synergies that come with being a part of a larger group, and potentially even benefit from a bigger multiple when that bigger group goes and trades to the next private equity. But yeah, there's certainly trade-offs both ways. I've seen a lot of groups that with the JV partnership, they say, we'll cap the multiple that you can trade your JV equity at, or you can only trade that equity to another doctor. You can't, because we need doctor ownership at that to have skin in the game. I've seen some say, no, you can trade a percentage of that at the higher DSO multiple, but it can, can only be a certain percentage. But the benefit is you do, have more influence over your specific domain, over your joint venture, and you tend to still get distributions. And if you can grow, add more practices, and that's also kind of part of your domain. So in some senses, it's, have your cake and eat it too, where you can still have ownership of your thing, but you can benefit from a lot of the synergies and benefits of scale from that partnership. So there's definitely pros and cons and a lot of nuance and a lot of complexity, but it has been interesting to see the evolution over the past 10, 20 years of these new models coming to try to cater to, your younger, your more risk tolerant, your higher growth audiences.
Yeah, that's another thing that makes this sector so interesting, but also a real challenge in that things can get complicated pretty fast. And I think a lot of DSOs use one structure or another to set themselves apart. It's not even compensation structure. That's too simplistic of a word. It's their model. And but it's tempting when you're doing that. You need a dentist that wants a different kind of model. Well, maybe we'll just do a one-off with you. And I think DSOs need to just be very careful. It doesn't mean they shouldn't do that, but they need to be very careful because you can quickly find yourself, looking, a bit like the Frankenstein DSO, right? I should have found a better word for it, but there you go. Okay, well, I think we have, Jamie, anything else on this slide? I think we've covered some good stuff here. Okay, awesome. Let's go to kind of this trends discussion, which is more or less the heart of our discussion. We've covered some of this already, but I would love to hear, maybe in the interest of time, Bob, do you want to just talk, maybe just kind of mush those first three bullets together into here's what's happening right now in the market. And then Jamie, let's talk about regulatory and policy trends for a minute after that.
Great. Macro environment, credit markets. I get this question all the time right now. Yesterday, I was on the phone with a 16 practice owner doctor who was asking the same question. Rates have gone up so much. How does this influence M&A? How does this influence valuation? And I play this game with my university students in my private equity class. Would you rather? So we build an Excel leverage buyout model, typical private equity valuation model, and we pull some levers. Would you rather decrease interest rate by 4 whole percentage points or increase growth by 1 percentage point, revenue growth? And it's a tough question because 4 versus 1 seems like obviously that 4% interest rate, that's such a huge change versus just 1% more growth. Well, growth actually dramatically outweighs even a 4% reduction in interest rate from a valuation and a return standpoint. So we're not seeing a whole lot of valuation implication driven specifically from the rates. Certainly there's a lot of talk about it and it does impact, but EBITDA as the definition doesn't include interest. So, it doesn't impact your EBITDA, it does impact your cash flow and ultimately, your net debt, but from a valuation standpoint, not a big driver. What is a big driver is the credit squeeze. So a lot of lenders are not lending as freely as they did last year. And so if I'm buying, DSO for 10 times, I'm used to being able to fund it with 5x, leverage or 5 times their EBITDA in debt, and then I'll have to come up with 5 times their EBITDA in equity. That leverage buyout. Now, if I can only get 4 times total leverage, my return profile is totally different. So that's going to squeeze the ability for me to pay up for that deal. So we are seeing a contraction in multiples, largely driven by the credit squeeze and credit contraction. Now, it's still a really favorable seller's market. People get worried because they compare this year to last year. Well, 2021 was just crazy in every regard, right? You look at every asset class, and if you were a seller in 2021, chances are you did pretty well. 2021 was just irrational in a lot of ways, whereas 2022 looks more just like a normal year. You compare 2022 valuations to previous years, and it's still a robust, healthy environment. I'm seeing less of a contraction in valuations from buyers, and I'm seeing more more sellers just not wanting to sell this year, partially because they came off a really robust 2021, and also partially because they're just getting squeezed in terms of their margins. So with wage inflation outpacing rate increases and being short-staffed, we're seeing a lot of folks, a lot of dental groups just not have as high of EBITDA this year as they did last year. So a lot of folks are hunkering down, working on their cost structure, refinancing to more flexible debt so they can, be opportunistic in this environment and grow. So we're seeing a lot more refinances than we are seeing folks, selling or DSO partnerships than the previous year. Of course, there's still tons of M&A activity. Valuations are still really healthy. Buyers are still very, very eager to buy, but sellers this year have been less eager to sell.
Well, do you think this space is, people frequently refer to medical space generally, but also the dental space is a little bit not recession proof, but not as affected by recessionary pressures. Obviously, cosmetics and other things are coming more into it. I don't know. Do you think that's still true?
Absolutely. Healthcare, dental is very much known to be recession resistant. Now, as you mentioned, there's certain pockets that are more prone to the impacts of recession. And that's why their investors are more eager to invest in healthcare and medical and dental in a recessionary environment. They view a flight to quality, a safe bet, safer place to put your capital than, a higher beta deal that is more recession prone. So, and even when I was in private equity, definitely, hey, this is a great sector to invest in. So, we see some headwinds, the macroeconomic environment, the credit squeeze, inflation. We see some tailwinds because typically dental is a great place to invest, and especially in a recession. So, ultimately, I view it as kind of net neutral in a lot of regards. You have some tailwinds, you have some headwinds. Hey, there's still a lot of great activity. There's still a lot of money to be made in M&A and healthcare.
Great. Let's go. Well, actually, yeah. Let's go to regulatory trends, and we can come back. I think we covered some of the strategic trends a little earlier, but we can go back to them, Bob, if we something there we want to touch on. But Jamie, I know there's a lot going on the regulatory side. You want to walk us through a few what keeps you up at night, or maybe it's what gets you up in the morning because it's probably exciting to you. So
exciting. Kind of actually. So I would say some of the very high level regulatory trends that would impact this dentistry space. First is always government pay, right? Like where are we going? What are we doing? Where are we going to go with that? There's been some incremental changes proposed by CMS to increase the scope of what dental services would be covered under Medicare Part B. Not a full force, everything covered, but as it relates to certain treatments, as it relates to certain diagnoses, that was just recently proposed and is out for comment now. So that could be something we see in 2023. One thing that I think is pretty interesting is I think this might be the first year where Medicare Advantage outpaces traditional Medicare. And as we know, Medicare Advantage does sometimes or usually include dental benefits. So I see that in my practice pretty significantly, the increase in MA, the focus on MA. I would expect that trend to continue on a pretty straight path. Another thing that I think is pretty important to bring up here is Troy and I were emailing back and forth a little bit about the PPP program and how dentists took advantage, and rightfully so, getting loans from the PPP program and then subsequently getting those forgiven. And obviously there was some back and forth and documentation provided in why practices or entities satisfied the terms in order to get those loans forgiven. There has been a pretty significant publicly disclosed push at the federal level, and I think at some state levels, assisting on the federal level, assisting the DOJ in going after or bringing enforcement actions where there's been false or fraudulent claims related to PPP loans. So we have seen it in many markets. We have seen task force kind of dedicated to this area. So it's just something to keep on your radar as an area of risk, and to make sure if you're thinking about selling your practice that you have the documentation and you can be fully supported. We've been seeing, and Troy can back this up, in our purchase agreements, there are representations and warranties pretty deeply covering PPP loan forgiveness compliance, rightfully so, because it's an area that we're seeing a lot of increased activity. One other thing that I wanted to bring up was teledentistry, right? Teledentistry kind of had a rise over the pandemic, and generally speaking, I see that it'll get pulled back a little bit as the public health emergency wanes. But I do think in some states it will, the waivers in place that were allowing telemedicine and teledentistry, there's a movement to put those into permanent place because people did see a lot of benefit from the telemedicine regime. So I think that the public health emergency has not been officially ended, right? It's been extended into 2023, I believe. But once that ends and practices are relying on waivers that are tied to that public health emergency timeline, you'll have to revisit those waivers that you're relying on. Telemedicine, Stark, Anarchic, there's a lot of waivers in place on that point. Let's see, anything else that I think, one other point, and this is maybe a little bit dated, but I think it's relevant to bring up here. There were some changes to the anti-kickback statute in we call it the regulatory sprint, the coordinated care. And the regulators were trying to expand or broaden and create more flexible or ways to accomplish safe harbor protection. Because like Bob was going through these like DSO 1.0, 2.0, 3.0, tomorrow he'll have 4.0. Like these are innovative structures that are not violating any regulations, but the regulations were drafted back in the 1970s, 80s, and they don't fit the innovative models. So it's a very general statement, but I do think once we start testing the changes to the anti-kickback statute and the accompanying regulations, we might see more precedent of how regulators are viewing certain models, and that might have some impact to allow more flexibility in the DSO space.
That's fantastic, Jamie. I think DSO 4.0s will be all this stuff on the blockchain, right? And we'll have all the records and the investor shares. Okay. Let's do on the policy trends. I just want to do a quick shout out. I sit in Utah, which is a bit of a hub in some ways for the dental industry. And we and one of our senators, Senator Romney, is on Health and Human Services, and that committee, and they're just really plugged in. And so they gave us a bit of a heads up on some policy that could help the dental sector. And these are just things that would Medicaid for adults, providing more access to dental insurance on the national exchange. And these are things that are not going to happen tomorrow, but they're out there being talked about. And all these things and what Jamie talked about, things that very much could basically inject more, I don't know, to put it bluntly, more cash into the system, which increases care. It increases the space, increases financial prospects for the sector. Bob, I think we talked about the DSO structuring, the 2.0 and 3.0, but the inflection points, I think that would be a really nice thing to cover before we move to our last topic.
I see inflection points from both sides. So if you think about from a dental operator or a dentist, I see folks kind of hitting this glass ceiling around 5 locations. And obviously everyone's different, and this is just a gross generalization, but an inflection point in terms of administrative complexity. It's hard to still be chairside. You can't visit every practice every day. You're starting to feel the administrative burden now, needing to invest in additional management and infrastructure. So private equity calls it a J curve. You know, you do an investment, you got to invest a bunch in corporate infrastructure. And so your EBITDA actually goes down in order to grow a lot faster, in order to kind of hit that J curve inflection growth. You know, we see that with dentists around 5, maybe 7 practices where you just have to make some of those investments. You can no longer do everything and you know, do wear all the hats. And it's this pivot or persevere moment where, you know, a lot of folks say, hey, this is the worst, this is horrible, my earnings have gone down, I'm, you know, working way more than I should, than I'm used to, I just want to go back to having, you know, a better work-life balance. Or we see some folks say, yeah, I'm just going to keep working through this, we're going to figure it out, and they work through it. There's also, on the same vein, an issue with financing. So usually by that time, your traditional financing sources, your bank views you as risk. I talked to 2 banks last week, and they've changed their policy. They said, we don't even lend to dental groups over 3 locations. Like that's crazy, right? But you know, the vast majority of dentists, the independent dentists these days, still have 1 or 2 locations and are very content with a personal guarantee and just paying off that principal as fast as possible, versus growth-oriented dentists that say, no, I want to retain as much cash as possible in the business and have access to more cash so I can do acquisitions and de novos and expand the existing locations. You know, from a bank standpoint, they don't get any of that upside. So to them, it's just risk. You say growth, they hear risk. And so finding different capital providers, different sources of financing, and that's kind of where this DSO 3.0 model really serves is, hey, you know, it's really difficult to grow. It's really difficult to find flexible financing. Why don't you just partner with us and we can, you know, solve some of those needs? But there are solutions for these folks. There's private lenders, there's different things that are out there they just usually don't know about. So administrative complexity, debt constraints, et cetera, really make it tough to kind of break through that glass ceiling and get to the 10th or the 15th location. And then by that time, from a buyer's standpoint, you know, the world really opens up. So from a buyer's standpoint, if I have a client, they have 5 locations, they're $1.5 million of EBITDA, you know, there's a lot of fantastic DSO partnership options for you. And we'll introduce you to them and we'll run a great process and help you find the best match. But once you get over that $3 million EBITDA mark, and of course, we're going to do the analysis and we're going to be aggressive, but very defensible in the number that we calculate. So you may think your EBITDA is 2, it may actually be 3. You may think it's 5, it may actually be 2. This happens all the time. We'll help you with that calculation. But once you clear that hurdle, now a lot of financial buyers are interested. It used to be a $5 million EBITDA low watermark or hurdle you had to clear. When I was in private equity, well, it's come down. Now a lot of folks are really interested, even if it's 3. Because they just want to get in the game. They want to, you know, pay to play, get in the game. Now there's a lot of things you can do to grow the business once you're in. So once we get a business, a DSO that's over 3, call it $3.5 million of EBITDA, now we can pitch that deal to not only the strategics, but also the financial buyers. That creates so much more of a robust, competitive process. And it just gives you so many more different opportunities and, you know, potential structures. So that's the inflection point we see from an earnings standpoint. As soon as you really clear that $3 million EBITDA mark, the world is your oyster.
I think that's high value information there, because the 5 million mark is, especially in other industries, is still, I think, is sort of where it's at. And so that's super good to know that here that's a good time to start reaching out. And like you said, if you have trouble finding capital, well, don't just think of private equity as an exit. That's a great source of capital for, you know, they take a minority interest in you, and now you've got a partner to help you grow. Okay. Great. So we just have a couple minutes left, or about 5 minutes left. So we're going to do a lightning round on the next, here we go, on the next slide, getting your house in order, or I guess your cabin in order, given our photo there. So let's, lightning round. Jamie, why don't you just sort of list off so what this slide is about is if you're the DSO, here are things you need to be prepared, because this is, on the flip side, the investor, this is the list they're going to go through, and they're going to look at this and they might, you know, deduct the valuation that you think you should be getting from your multiple because of risks they see in your business. So Jamie, maybe just, you know, hit some of those on the compliance side.
Yeah, absolutely. And Bob, when we were preparing for this section, you said it super well that like these things will not kill a deal unless the issue is catastrophic, right? But they will slow down a deal and they will put time into the transaction that you just don't want. And you can cut that time by a lot by kind of getting your house in order. I think that was your phrase. So from my perspective, traditionally on the buy side, if we come to a practice and we're acquiring and they've already done an internal chart review, looked and measured whether there's any issues with coding or billing or overutilization, any trends. A lot of times an outside consultant would do that, but it doesn't need to be some robust, big project, especially if you're a 1-doc, 2-doc practice. Similarly, marketing schemes is an area where a lot of dentists, and I'm sure a lot of people on this webinar are familiar, that's an area where there's a lot of risk from the regulatory perspective. So if you've analyzed your marketing platform and maybe ceased the practices that are called into question, providing certain benefits or handouts to Medicare, Medicaid beneficiaries, that's the big ticket there. Then privacy and security, obviously, like this is not even a healthcare thing. It is for HIPAA, but like we are living in a world where there's ransomware and there are like cyber attacks all the time. And so to make sure that your systems, both from a HIPAA and also from a consumer credit card privacy standpoint, you've looked at it, you've thought about it, you have the minimal requirements in place to protect your systems, that goes a long way, I think, in getting your house in order.
That's perfect. And even just simple cybersecurity, I mean, it feels like almost every client I have has been hit with some kind of, scheme to extract money. So just a quick training for your employees. Okay, Bob, what would you hit on the remainder of what's on this list?
Corporate governance, and I'm going to take that to just mean make sure that your contracts and agreements with the minority partners or with your other dentist partners, those are done and those are solid, because I've had multiple times where we've gotten to the end of a deal, and big money sometimes makes people crazy. Big money sometimes make rational people do irrational things. And so we've had instances multiple times where there's some, minority shareholder that we didn't even know about. And they come out of the woodwork, right before close, and they say, hey, I need XYZ in order to sign off on this deal. And they can effectively hold the deal hostage. 11 p.m. night before close, like we're in a war room dealing with somebody. You're going to lose years of your life over this moment. Don't let that happen to you. Let's get those agreements ironclad while you still have the leverage, versus, when they know big money's at stake and now they make just crazy irrational demands and literally hold you hostage. So that's a big one. And I would, as part of getting your house in order, there's some simple things we can do to just save a lot of brain damage and deal fatigue and potentially, killing a deal down the road.
I couldn't agree. I think that and the compliance are probably the two biggest pieces. It feels like almost there's so many deals you get, you start doing the due diligence or preparing for it, and there's just a question like, I don't know, this dentist used to own some, now they don't, but the documentation doesn't really reflect what people believe to be the case, and that's just a mess. So, okay, look, we are out of time. I want to give a huge thanks to Bob and to Jamie and to you for participating. If you like this, then I would normally say give us a good review. I don't think it's rated that way. Forward it to your friends. This is high quality stuff. And thanks everyone. We'll see you later.
Thanks, Troy. Thanks, Jamie.
Thanks, Troy. Thanks.
Thanks all.